Last night at 2:17 a.m. Eastern Time, a number changed. You were asleep. The markets were closed. But deep in the Federal Reserve's database, an algorithm recalculated a benchmark rate that you have never heard of. It's called SOFR, Secured Overnight Financing Rate. It spiked to 5.43%. That doesn't sound like much. But this morning, without any announcement, without any news headline, your credit card company just repriced your variable balance. Your home equity line of credit just became more expensive. Your adjustable rate mortgage just reset higher. The invisible hand didn't guide the market. The invisible benchmark just moved your cost of living. In this investigation, you will learn 3 things that your bank will never explain to you. First, what SOFR actually is, and why it replaced the scandal-ridden LIBOR system. Second, the exact mechanical pathway from a 2 a.m. data point to your 9 a.m. credit card statement. And third, why the spike we just witnessed is not random noise, but a warning signal that the overnight funding system is under stress. This is not about the Federal Reserve's policy rate. This is about the rate that actually matters. The rate that moves while you sleep. Educational analysis only, not financial advice. This is the story of the hidden benchmark that controls your wallet. For most of human history, interest rates were simple. A lender and a borrower agreed on a number, but in the modern financial system, almost nothing is simple. Your credit card agreement says something like this. Your APR is the prime rate plus 15.99%. Or your home equity line says, rate equals SOFR plus 2.5%. You signed it, but you never asked, what is prime? What is SOFR? Who decides these numbers? Here's the truth. Most consumer loans in America are not fixed rate. They are floating rate. The rate floats on top of a benchmark. The benchmark is supposed to reflect the true cost of money in the financial system. For decades, that benchmark was LIBOR. The London Interbank offered rate. It was the rate at which big banks claimed they could borrow from each other. But LIBOR had a fatal flaw. It was based on estimates. Banks self-reported their borrowing costs. And, as we learned in 2012, banks lied. They manipulated LIBOR to make profits on derivatives. Trillions of dollars of contracts were priced off a rigged number. The scandal destroyed careers and triggered billions in fines. So regulators said, we need a new benchmark, one based on actual transactions, not estimates. In 2021, the financial system began a forced migration. LIBOR was being phased out. The replacement in the United States became SOFR. Unlike LIBOR, SOFR is calculated from real trades. Every night, the New York Federal Reserve looks at the repo market. They see how much interest banks and hedge funds actually paid to borrow cash overnight using treasury bonds as collateral. They take the volume-weighted median of all those transactions. That number becomes SOFR. It publishes the next morning at 8 a.m. This sounds technical, but here's what it means for you. If you have a variable rate loan tied to a SOFR, your interest cost is now directly connected to the overnight funding stress in the banking system. When repo markets are calm, SOFR is low. Your loan is cheap. When repo markets are stressed, SOFR spikes, your loan gets expensive. You are now a passive participant in the money market, whether you know it or not. Let's trace the pathway, step by step, from the repo trading desk to your credit card bill. Step 1, the overnight session. It is 6 p.m. Eastern on January 22nd, 2026. The repo market opens. This is where banks and hedge funds borrow cash for one night. A hedge fund holds $100 million in treasury bonds. They need cash to meet a margin call. They go to a bank and say, lend me cash overnight. I will give you my treasuries as collateral. The bank says, fine, but I want 5.4% interest for one night. The trade happens. Thousands of these trades happen every night. The Fed's computers capture all the data. Step 2, the calculation. At 2:17 a.m., the New York Fed's algorithm runs. It looks at all the repo trades from the prior session. It filters out outliers. It calculates the volume-weighted median interest rate. On January 22nd, that number came out to 5.43%. This is significantly higher than the prior day's SOFR of 5.31%. A 12 basis point jump in one day. This number is uploaded to the Federal Reserve's website. It sits there waiting for the world to wake up. Step 3, the bank's morning update. At 8:05 a.m. on January 23rd, the Treasury Department of every major bank in America logs into their systems. They pull the new SOFR rate. Their loan pricing models automatically update. If your credit card is tied to SOFR plus 15%, the computer doesn't ask permission. It just recalculates. Yesterday, your rate was 28.31%. Today, it is 20.43%. The change is small, but it is automatic. You're not notified. There is no letter. The terms of your original agreement allow this. Step 4, the compound effect. Now imagine this happens not once, but repeatedly. Imagine SOFR stays elevated for a month. That 12 basis point increase becomes 50 basis points. Your home equity line of credit, which was charging you 7.8%, is now charging you 8.3%. On a $100,000 balance, that is an extra $500 per year in interest. You did nothing wrong. You didn't borrow more. The benchmark just moved. Here's the part no one explains. SOFR is not controlled by the Federal Reserve's Policy Committee. The Fed sets the federal funds rate through announcements, but SOFR is set by the market. It is the interest rate that the market demands for overnight lending. If banks are nervous, if liquidity is tight, if there is stress in the system, SOFR can spike even if the Fed has not changed policy. This creates a hidden transmission channel. The stress in the wholesale funding market flows directly into your household budget. And last night, that channel activated. The spike to 5.43% is the highest SOFR reading since the debt ceiling crisis of 2023. Why did it spike? There are three possible explanations. Explanation one, year-end effects lingering. The end of December always causes stress in money markets. Banks window dress their balance sheets. They reduce repo activity to look safer on paper. This reduces liquidity. Even though we are now in late January, the hangover from year-end balance sheet management can persist. Banks are still recalibrating their risk models after the quarter-end snapshot. This means they are slower to lend, more cautious with their balance sheet capacity. Explanation 2. Treasury issuance wave. The Treasury Department is flooding the market with new bond supply to fund the government. When the Treasury auctions bonds, it sucks cash out of the banking system. Dealers buy the bonds, then they need to finance those positions in the repo market. High supply of bonds needing financing pushes repo rates up, which pushes SOFR up. In January alone, the Treasury is expected to issue over $500 billion in new debt. Every single dollar of that debt needs to be financed somewhere. The repo market is absorbing that flow. Explanation 3. Reserve scarcity. This is the scary one. The Fed has been shrinking its balance sheet through quantitative tightening. This drains reserves from the banking system. If reserves fall below a critical threshold, banks start hoarding cash. They become unwilling to lend in the repo market. This causes rates to spike. The September 2019 repo crisis happened for exactly this reason. SOFR exploded to over 10% in a single day. The Fed had to intervene with emergency lending. We don't know yet which explanation is correct. But the spike is real, and the mechanism is now armed. Every consumer with a floating rate loan just became exposed to the invisible stress fractures in the banking system. Now let's follow the domino chain. Because a SOFR spike doesn't stay in the money market. It cascades. Cascade 1, credit card reset wave. There are approximately $1.1 trillion in outstanding credit card balances in the United States. Roughly 60% of that is variable rate, tied to either prime or SOFR. That is $660 billion of debt that just repriced higher overnight. The average cardholder will not notice a 12 basis point change, but if SOFR remains elevated or spikes further, the cumulative impact becomes brutal. A household carrying $10,000 in credit card debt at a variable rate will pay an extra $120 per year for every 1% increase in SOFR. That is $10 per month. It sounds small until you realize this is on top of inflation, on top of rent increases, on top of grocery costs. For families already living paycheck to paycheck, this is the difference between making rent and falling behind. Cascade 2, home equity line freeze. Many homeowners took out HELOCs during the low-rate era of 2020-2021. They were sold on variable rates starting at prime plus 0.5%, which seemed cheap at the time. But SOFR-based HELOCs are now resetting higher. Some homeowners are seeing their monthly payments double. When this happens, they stop using the line of credit, they stop remodeling their kitchens, they stop buying cars. This removes consumer spending from the economy, which slows growth, which pressures corporate earnings. The contractor who was counting on that kitchen remodel job doesn't get hired. The appliance store doesn't make the sale. The ripple spreads. Cascade 3, corporate floating rate debt. It is not just consumers. Corporations also borrow on floating rate terms. Leveraged loans, which are used by private equity firms to finance buyouts, are typically priced at SOFR plus 4%. There's over $1.4 trillion in leveraged loan debt outstanding. If SOFR rises by 50 basis points and stays there, the annual interest expense for the entire leveraged loan market increases by $7 billion. That is $7 billion that does not go to worker wages, capital expenditure, or dividends. It goes to lenders. Companies start cutting costs. They freeze hiring. They delay expansion plans. The economy slows not because of a recession, but because of a benchmark rate that moved in the dark. Cascade 4, the derivative unwind. Here is where it gets truly dangerous. SOFR is not just a loan benchmark. It is also the reference rate for trillions of dollars of interest rate swaps. A swap is a contract where two parties exchange cash flows based on interest rate movements. Many corporations and banks use swaps to hedge their interest rate risk. But if SOFR moves violently, these swaps can generate massive margin calls. A company that thought it was hedged suddenly has to post billions in collateral. If they don't have the cash, they have to sell assets. Forced selling creates volatility, which triggers more margin calls, which creates a feedback loop. This is how a 12 basis point move in an overnight rate can spiral into a systemic crisis. And here's the hidden risk that almost no one is talking about. The SOFR derivatives market is still young. LIBOR derivatives had decades of history. Traders understood how they behaved in stress. SOFR derivatives have only existed since 2021. We have never seen them tested in a true liquidity crisis. The models assume they will behave like LIBOR swaps, but models are just guesses. If SOFR spikes to 7% or 8% in a flash crash, we have no idea how the $200 trillion derivatives market will react. The untested plumbing could shatter. But here is the key insight. None of this shows up on the evening news. When the Fed raises the federal funds rate by 0.25%, it is front page news. Every analyst dissects it. But when SOFR spikes by 12 basis points due to money market stress, there is silence. The financial media ignores it because it seems technical. But the impact on households and corporations is just as real. In fact, it is more real because it happens immediately. There's no delay, there's no announcement. The rate just changes and the costs flow through. Now, let's talk about the banks. Why did they allow SOFR to spike? Why didn't they step in and lend more to stabilize the rate? Because they are constrained. Banks are subject to capital requirements and leverage ratios. If a bank expands its balance sheet by lending in the repo market, it consumes regulatory capital. At certain times, especially around quarter end and year end, banks pull back from repo lending to preserve their capital ratios. This withdrawal of liquidity is what allows rates to spike. This is the central tension in modern finance. The regulators want banks to be safe, so they impose strict capital rules. But strict capital rules make banks less willing to provide liquidity during stress. The result is a system that is theoretically safer, but practically more fragile. A small shock can cause large price moves because there are fewer market makers willing to absorb the shock. And this is where the Fed comes in. If SOFR stays elevated, if it spikes further, the Fed has tools. They can inject liquidity through overnight repo operations. They can expand the standing repo facility, which allows banks to borrow directly from the Fed at a fixed rate. But these are emergency tools. If the Fed has to use them, it signals that the market cannot function on its own. It signals fragility. So we are watching a test. Can the money market stabilize on its own, or does the Fed need to intervene? The answer will determine whether this SOFR spike is a one-day blip or the first tremor of a larger quake. Let's bring this back to your life. What does this mean for you practically today? Consequence 1, check your loan terms. If you have any debt with the words variable rate, adjustable, prime-based, or SOFR-based in the agreement, you're exposed. Log into your account, look at your current APR, compare it to last month. If it has increased, that is the SOFR spike hitting your wallet. If you can refinance into a fixed rate, now may be the time. Locking in a rate protects you from future benchmark volatility. But understand the trade-off. Fixed rates are higher than variable rates today. You are paying for certainty. The question is whether that certainty is worth the premium. If you believe SOFR will spike further, the answer is yes. Consequence 2, understand the lag effect. The SOFR spike happened on January 22nd, but not all loans reprice instantly. Some reprice monthly, some quarterly. Your auto loan might not show the increase until February. Your student loan might not adjust until March. Do not assume you are safe just because your bill looks the same today. The repricing is coming. Check your loan documentation. Look for the phrase rate adjustment date. Mark it on your calendar. That is when the SOFR spike will show up in your statement. Consequence 3, watch the money market fund yields. If you hold cash in a money market fund, you're actually benefiting from the SOFR spike. Money market funds invest in short-term instruments tied to overnight rates. When SOFR goes up, money market yields go up. This is one of the few times where rising rates help savers. But this benefit is fragile. If the spike causes a crisis, money market funds can break the buck, meaning their net asset value falls below $1 per share. This is rare, but it happened in 2008. If you see money market yields spiking above 5.5%, it is a warning sign of stress. Consider moving some cash into FDIC-insured accounts, even if the yield is slightly lower. Safety trumps yield in a crisis. Consequence 4, corporate profit pressure. If you own stocks, especially in leveraged industries like private equity, real estate, or retail, understand that rising SOFR increases their debt costs. This compresses profit margins. Earnings guidance could be revised lower. Stock prices could fall even if revenue is stable, because interest expense is eating into net income. The SOFR spike is not just a consumer problem, it is an equity market problem. Watch the earnings calls in the coming weeks. If CEOs start mentioning higher financing costs or SOFR headwinds, that is your signal that the spike is hurting corporate America. Consequence 5, The Fed's dilemma. If SOFR stays elevated, the Fed faces a choice. They can intervene with liquidity injections, which stabilizes the rate but expands the Fed's balance sheet. This reverses their quantitative tightening policy and signals that the market cannot function without Fed support. Or they can let the market clear on its own, which means accepting higher borrowing costs and slower economic growth. Either choice has consequences. Intervention signals weakness. Non-intervention risks recession. Watch the Fed's daily repo operations. If you see them ramping up emergency lending, it means the SOFR spike is worse than they are letting on. The data is published every morning at 11:30 a.m. on the New York Fed's website. If you see the standing repo facility usage jump above 10 billion, the stress is real. Here's the reality. You cannot control SOFR, you cannot vote on it, you cannot opt out. If you have variable rate debt, you are a passenger in a vehicle driven by the overnight money market. And right now, that vehicle just hit a pothole. The spike to 5.43% is a signal. It tells us that liquidity is tightening. It tells us that banks are becoming more cautious. It tells us that the financial system is under more stress than the calm surface suggests. This is not a crisis yet, but it is a tremor, and tremors often precede earthquakes. In our next investigation, we are going to look at the other side of the funding market, the Treasury General Account, the government's checking account at the Fed. Right now, the Treasury is burning through $700 billion in cash to avoid breaching the debt ceiling. This is draining reserves from the banking system at the exact moment when repo markets are stressed. The collision of these two forces could be the trigger for the next liquidity crisis. We will map out the mechanics, the timeline, and the signals to watch. 3 things to monitor this week. 1. Daily SOFR prints. If we see another spike above 5.5%, the stress is accelerating. 2. Fed repo facility usage. If banks start borrowing from the Fed's standing repo facility, it means they cannot get liquidity from the market. 3. Your own loan statements. Check your APR. If it changed, you now know why. Subscribe for investigations into the financial mechanisms that move your money while you sleep. The benchmark just spiked. The question is, will it spike again?